Once again, thank you, everyone. Good morning. Great turnout. We're really happy with the content this year and really informative discussion with Jay and Yonatan. Typically, it would be pretty tough to top, but fortunately, we have Sam and Joel here this morning to tell us exactly where interest rates are going. And
Jay will answer that one. Where's Jay?
I heard Jay say taxes are going down, so good news. But no, kidding. But what better time to provide an update on the current debt environment, especially from a lending perspective. And of course, we will talk interest rates. So we'd like to introduce our panelists. We've got Joel Kirstein here. He's here with us from Houston, Texas. So we appreciate him making the trip. Joel is Managing Director of Mortgage Banking and a National Team Lead for Berkadia's Single-Family Rental and Build-for-Rent Specialty Group. Joel joined Berkadia in 2017 and is responsible for multifamily and single-family loan origination and equity placement. He has closed over $2 billion worth of transactions in his career and has a wide range of real estate and financing expertise, including Fannie Mae, Freddie Mac, and life insurance company executions. And quick fun fact for those of you who don't know, Berkadia is actually partially owned by Berkshire Hathaway. I just learned that recently. Berkshire Hathaway and Jefferies. And then we also have Sam Mosser here with us today. Sam is here with us from Bankers Trust, where she is the Nebraska Market President and a member of the bank's management and senior loan committees. She's accountable for the bank's Omaha market performance, which includes recruiting and retaining top talent and increasing deposits, loan volume, and profitability. Sam has over 25 years of commercial banking experience in the Omaha market and is very involved in the community. So again, thank you both for being here this morning. And I've got a few questions kind of tailored to both of you, but please feel free to interject whenever. And I'm going to keep a timer going here, so please forgive me if I cut you off. I want to make sure we get to the good questions. So first question, Joel, we'll start with you if that's okay. Metonic has a long history of working with agency lenders to provide long-term fixed-rate debt. This would include Fannie Mae, Freddie Mac, HUD. Can you discuss how the agencies are currently doing the multifamily market and whether the agencies are still looking to deploy capital?
Sure. Can everyone hear me okay? So by way of background, looking on the company, we are a originator on behalf of Fannie, Freddie, and HUD. So in terms of national rankings, we're number one Freddie Mac lender, or number two-ish with Fannie Mae, and then number one in terms of multifamily originations with HUD. So company-wide, we do about $40 billion in debt a year. So just to provide some context, as it pertains, and I want to pick up on the affordable question a little bit on the agencies, because what has happened in the last year is it's shifted. Fannie and Freddie are geared for providing liquidity to the multifamily market, specifically during times like these when capital markets are tough, there's a lack of liquidity in the market. That's part of their mission. The second part of their mission, and the one they're really focused on, is providing liquidity to the market as it pertains to, I'll use affordable. When I say that, I'm not talking like LIHTC tax credit type affordable, but affordable based on the area median income. So they're designed to provide liquidity. What's happened in previous years, Fannie Freddie was able to, they put out a scorecard every year, which is their rules as to how they're going to deploy their capital. For that year, they get an allocation, and then there's rules how they'll deploy it. Well, previous years, with the exception of 2023, they could put out as much money as they wanted within a certain context related to number of units. So if I hit my unit goal for affordable business, then I can do as much core Austin, Texas tower business that I want across the country. And they're also heavily weighted towards their select sponsors, which are those borrowers that borrow very frequently. What changed this year, and I think it's a precursor to a comment or Jay's response of what we need. It's not a mandate yet, but what Fannie and Freddie are starting to do is now they're shifting towards true affordable workforce housing. And the way they did that this year is they switched the rules. The rules now are based on the $70 billion I'm going to give you, Freddie, and the $70 billion I'm going to give you, Fannie. You have to deploy so much capital on a percentage of that dollar amount. So it's not units anymore. So I can't do two big affordable portfolios and then pump the rest in the core markets. I have to do a percentage of 80% of AMI less, 60% of AMI less, 40% less, and then there's the big A affordable tax credit. So the good news is for multifamily investors is Fannie and Freddie have been there. They are still there. They're still lending. They're coming up with creative solutions to offset the current environment of the market. They're doing, in some cases, 35-year amortizations. They're doing interest rate buy downs. They're providing spread relief if you have workforce housing. And so when everyone's starting to retract in this space, Fannie and Freddie has stepped up. And so the borrowers that have the relationship with them are in a very good position going forward, because going into 2024, liquidity is going to be an issue on the debt side. And Fannie and Freddie will still be there to lend. Now, it'll be interesting to see how and if the scorecard creeps further into that mission of providing affordable liquidity. We won't know that till probably into November, early December. And when that comes out, our firm publishes, here's what this means to you as an investor or a borrower. But the good news is their allocation didn't decrease. That was the first thing we were worried about. And the first thing we'll watch for this year, are they going to get less money to put out? And if so, are there going to be more stages?
Great. Thank you, Joel. And I guess the other things we've been seeing in the agency market is, talks of looking closer at full-term IO. Is there any big developments you've heard from Fannie Freddie or anything else as of late outside of the scorecards?
Nothing specifically. Recently, Fannie Mae, and we'll send this to the Atomic Tank that they go forward to the everyone that's present today. They can send an email out. Fannie Mae specifically has recently structured a lot of pricing waivers and more interest only, again, based on affordability. What they're trying to push for is operators taking a market rate deal and then designating a certain percentage of those units and restricting the rents. So again, it's not being forced yet, and you don't know if it will, but they're starting with the carrot versus the stick first. And so that's something that recently has happened. Fannie Mae is incentivizing sponsors to really focus on restricting rents for a certain percentage of their units. We'll send that around so you have some color on that. And then again, what we believe will happen is there will be further incentives going into next year when the scorecard comes out as it pertains to self-inflicted rent restriction.
Well, awesome. Yeah, we will looking forward to getting those materials from you, and we'll be sure to share that with our investors. Thank you for the comments there. And then second question, I'm going to pivot to you, Sam. So in addition to the agencies, as Jay mentioned, bank lenders play a really vital role in multifamily financing. In our case, and you see it mostly through providing construction debt and bridge debt. So can you talk about what trends you are currently seeing with bank debt in today's market?
Sure. And I know there's a lot of bankers in the room, so I'll just describe what's happened to our industry, and they've all lived it. So, during 2020, banks were flush with liquidity. People were fleeing to safety. There was a lot of incentive money in the market, whether it was PPP or individual incentivized payments. And so all banks were flush. And in March of this year, that changed with SVB. And what most people probably on the streets don't know, a lot of the people in the room do, is that SVB was very different than your local community banks. Their average deposit per person was $5 million, whereas here locally, it's probably like 5 to 10,000. And so it was just a different situation, but it's created this sense of fleeing again to safety, but away from community banks, which isn't helpful for the market. So I would put a plug in for all of our local banks, keep your deposits local. But even with that, I just looked at our own trend lines at Bankers Trust. If you take out the high of COVID and the low of after SVP, our trend lines are all still the same, and it's all still growth. So the community banks are still very healthy and doing well. And so we're still deploying capital. I think that people are looking at each market individually. So when we're looking at doing construction and bridge loans, we've closed on $100 million, and I'll talk about Omaha specifically, in new construction multifamily loans this year. So we're still lending, and I know other banks in the room are doing just the same thing. But we're getting feasibility studies. We're looking at projects. Omaha has so many different submarkets, so we're looking at each submarket specifically. So I think we're looking, Bankers Trust has a bigger footprint. So on other markets, we pulled back just because of the market fundamentals. So we're looking at those closely, but we're still lending. I know a lot of our bank partners in town are still lending because we partnered with them on deals. So I know it's still happening, but I think people are just taking a closer look at it. And I don't know if it's with this question or another one, but I'll go ahead and address it. What's happening, though, is because interest rates have gone up so much relative to cap rates, loan to value is no longer a question. I mean, we're not even talking about loan to cost or loan to value. We're talking about what does it take to get to 130 debt service coverage ratio, and that's typically a 60% loan to cost or value. So what's driving our underwriting is cash flow versus looking at the loan to cost and loan to value, just because of the market fundamentals. Cap rates for multifamily have only gone up 75 basis points in the last year, but interest rates have gone up 5.25%. So just, we have to look at things differently, but we're still doing deals.
Great. Well, thank you for that.
So for context on your construction loans, what's your average loan size and what's your maximum that bank will hold on balance sheet?
And that's going to be different by bank, but us specifically, we're holding about $30 million per project. But we've closed on projects much larger than that, again, with partners, and some of them, those partners are in the room. So we're still doing deals that are larger, but I know there's other banks in town, that'll take $10 million chunks, and there's some banks in town that'll take 40 to 50. But typically over that, people are wanting to partner just so that nobody has concentrated risk in any certain project.
And, it's an important distinction because presumably most of everyone here that invests is investing in the local region, right? And so what we've seen at a national scale is big money center banks are on the sidelines. You can bring in the best deal, the best sponsor, big money centers on the sidelines. And then based on concentration, there's a lot of the regional banks, like throughout Texas for the most part, many of the Texas banks on the sidelines, not lending at all, especially on construction lending. Now, if there's it's an acquisition loan and there's cash flow, it's a different story, but for construction lending, so what you've seen is any deal north of $30 million has a very hard time getting capitalized with banks today. And those like in the Southeast Florida, for example, now we're seeing requests for, if there's a loan, 30 million plus, and it's a syndication, I've got to deal with two banks that want new deposits. And we're starting to see requests between 10 to 30% of the loan amount just to have a deposit. This has nothing to do with the project, but the fundamentals of the project, interest reserves, this is just you need an additional liquidity deposit here of 10 to 30%. I mean, so if you think about 30% deposit on a $30 million loan, your borrower's not going to do that. So now we've seen the influx of the debt funds. Okay, I was curious here.
And I would say, and like I said, it's market specific. So Bankers Trust is we have loans in 49 states. Alaska is the only state we haven't gone to. So we are on a commercial real estate perspective, and that's why it's so market specific. But Omaha's it just came out, I think this morning, or within the last couple of weeks, Omaha's had rent growth, and I think it's the top in the country right now at 4%. So the fact that we're still having rent growth at those levels compared to the rest of the country, I think it says a lot about our market and where the supply and demand are. But I mean, all of us have to be cautious about what the supply is at any given time. And I think that the feasibility studies are really so important. And we have had one client that came to us with a project for, I think it was 300 and some units. Gordon's in the room. He can correct me on the math. And then they came back to us and they said, instead, we're going to phase it. We're going to do 100 units to start, and then we'll do a phase 2 and 3 if we need to. So I think it's just the market fundamentals and looking at each specific submarket to make sure it makes sense.
Great. Thank you both. And so along those lines, other than, a closer look at sponsors, closer look at the market, have you started to see any significant changes in deal structures outside of the need for deposits now, which is obviously a turn from the banking world the last few years? Any changes to covenant structures or anything you're seeing?
So for a while, when we saw the banks kind of start going to the sidelines across the country, again, we have my team's footprint is coast to coast. So what was interesting to us is for about 2 quarters, the life insurance companies stepped in very aggressively for construction lending specifically. And when the banks started becoming more conservative, we saw the life companies step in and they were capitalizing deals, and we were getting 65% of cost. You were getting non-recourse loans. You were getting significant reduction in interest rate floors, 4%, sub 4%. on our interest rate floor. So we were getting really strong terms and conditions. And then what happened is everybody figured that out. And the life companies immediately started retracting to, one, best-in-class sponsorship, two, market fundamentals, which has always been a life company thing anyways, for the most part. They're not going to lend in a lot of these tertiary markets, especially on the construction side. But then what we saw is them starting to throttle the inbounds by asking for recourse, which is very interesting because predominantly life insurance companies are non-recourse lenders. We started seeing life companies looking for repayment guarantees at an entity level upwards of 50% of the loan amount, which was, again, unique. And so part of it was they were asking for it because they're getting it. And two, it was another filtering strategy, right? They had so much inbound business. And there's only a finite amount of construction capital that life insurance companies will get allocated for every year. So that was a significant change. And then what we started to see is spreads widening. We started to see leverage coming down, changing their underwriting. And now we need to underwrite to 125 cover instead of 125 at 130. And so we saw that retraction back. And now we're to the point where in most markets, the life insurance company capital's on the sidelines as well. For the remainder of the year, they're worried about what their allocations will look like for next year. Not just for construction lending or for bridge lending or for permanent lending, but for real estate allocations in general. So I think it's something collectively as an industry we need to pay attention to. We heard a lot of, hey, we have $2 billion in 2022, and for 2023 we've got $1.8 billion or $1.6 billion from life companies. So we already saw the retraction of capital being allocated to them to lend into the space. But there was a moment in time where they really stepped in aggressively when the banks were kind of paying back. We're trying to figure out where to make their bets. They stepped in aggressively, and then now that has shut up. And now the debt parties are aware of that, the price hit.
We haven't changed our covenant. I mean, our policy and guidelines have remained consistent. We're different from the life and the other ones, and I would say most of the community banks are probably the same in town. We're typically recourse lenders, especially during construction, unless there's, bonded or really low loan to cost. I mean, there's got to be some mitigating factors, but for the most part, community banks are recourse. It can burn off over time, stabilization or different things. But for us, the covenants, but again, to us, what's changed the most is we're really underwriting to the debt service coverage ratio and where the leverage lands because of interest rates. And, we have a lot of debate with our clients on, do we use today's prime rate to underwrite it? So is it at 8.5, or do we do it based on what they can get from Fannie and Freddie, which is probably more in the 6s? I'll let Joel speak to that. But where do we underwrite it to come up with our debt load? So that's where probably we're spending a lot more time talking about that because, like I said, the loan to cost is just really not a conversation piece right now.
Well, thank you both. And so my next question, we kind of hit on life insurance companies a little bit. And Joel, you mentioned debt funds. So you mentioned life insurance companies kind of coming in at a moment in time when banks were tightening up. Just along those lines, do you think this environment could bring additional opportunities for alternative lenders, and including debt funds?
Yeah, well, so we're already seeing that. We've seen capital preservation funds, private labeled lenders that have stepped into the space. Some are doing full-term IO type permanent loans to compete with Fannie Freddie, although it's right. If you can borrow from Fannie Freddie, you're still going to go that route. But for those that can't, the markets that don't lend itself to that. So we've seen that. Private label lenders that are using managed account money, international money. There's a debt fund in the market now that's doing construction financing for multifamily and single-family build events. There's a capital preservation fund out of Salting that they raised $500 million of equity. They backed up to about $1 billion buys. And they're like, and it's construction money pricing, so the high threes is pretty good at 60 to 65% of cost leverage for non-big flush loan. So we're already seeing some of that. What we're seeing on the bridge lending side, we're starting to see a lot. Interestingly enough, there's a couple very large groups that are backed by very large multifamily operators. So now they're stepping into that side of it, and they're providing bridge lending liquidity in a market where that bridge lending liquidity is not up to lot because they have their CLO execution on the back end. So they take what they're doing is pulling loans and then selling. So maybe some Canadian doesn't know it's CLO execution. But so we're seeing some of those new trends coming in and stepping in, because to Jay's point earlier, the vast majority of value add transactional volume is financed through 2+1 or 3+1 if they weren't using a relationship bank in the debt fund space, floating rate debt. And so you had, for the most part, unsophisticated borrowers with moderate to weak balance sheets that syndicated all their equity through LinkedIn. And I'm not saying that tongue in cheek, like the majority of them raised money through LinkedIn. And they bought a really cheap interest rate cap. And now their plan is either behind or their loans coming due, and they don't have enough stabilization to take out with funded debt. They're not bankable. They're vague. Fannie Freddie won't touch them because they haven't been borrowers of Fannie Freddies. And so their loans due, and they've got to buy a new interest rate cap, which is going to cost them $1 million to buy another 2-year cap. So a lot of those debt funds are in trouble. They've got a giant portfolio of weak borrowers and upside down loans. That's where this part of the distress is going to come, is right sizing that component. So what happened is new entrants stepped in. He said, "Oh, we'll be the next debt. We'll kind of bail you out. We're going to charge for it. We want to see your loan condition, and 80,000 units. And so if you fall on your face, that's okay. We'll take your keys and lose money." So we're starting to see some of it.
I was going to ask you, you mentioned some debt funds at the, still in the 3s and 4s and wonder, what's the catch there? And I think along those lines is a lot of them are maybe more of the loan to own. Are they tough to work with?
So let me take a step back. The debt funds that are pricing in the high 3s to 4s are pricing for good groups like yours, like groups that have experience, track record, good stable base of investors. They don't have a 5-year fund horizon, that the guns to their head no matter what they do. The rest of that market is high 4s into the 5s, even in the mid 6s, depending on it. And I would say those that are pricing at 5s to high 6s or at 5s to mid 6s, those groups are okay. And where you'll get tripped up with that is within a lot of like cash flow covenants and the documents. If you don't know what you're doing, or you're working with a inexperienced team, or you're going to pay inside as your advisors, you'll get stuck into a mode that's going to hit it. And they start seeing that.
Well, thank you. And so these next final few questions here, we're right on time. I'm going to open these up to both of you. And so we'll just plan on alternating the first word if that's okay. So maybe I'll start back with you, Sam, then we'll turn it over to Joel. And I was kidding earlier, but in all seriousness, can we call this a debt panel if we don't really guys on interest rates? So the next question, interest rate increases have been the largest disruptor in the multifamily market over the past 18 months. Can you please give us your thoughts on where interest rates go from here, both short-term and long-term?
Yeah. So, well, the good news is that whatever we say can be totally wrong and nobody can hold us accountable, right? So, all the economists at the beginning of this year said that there would be 100% certainty of a recession by the end of the year. And of course, that hasn't happened. And now they're saying 2024. And Powell has said rates, and I think Jay said it this morning, he's going to keep rates high as long as inflation's an issue. But he's also said that from a long-term perspective, he'd like the Fed funds rate to be around 3.5%. And Dwayne's on the Fed board, so he could speak more to this than we probably can. But so that means rates would go down 2% from where they are today. But I think most banks and most people budgeted for rates to go down at some point this year, and everybody was wrong. And so in next year in our budget, we have rates being steady through most of the year, but starting to trail down and maybe the third, fourth quarter of next year. But again, we could all be wrong. I think Powell will keep the rates high until inflation is under control, but there's so much geopolitical risk right now. It's really hard to predict because based on the daily news, depends on what they're saying. So I think Powell said in the last couple of days that, he plans to keep rates pretty steady or sent that signal. Again, Dwayne at the back of the room can correct me if I'm wrong, but at the next Fed meeting. And then after that, we'll see kind of what happens. But I guess I don't have a crystal ball, but we also have an inverted yield curve. So that's telling you that they predict rates to go down. Although that inversion keeps narrowing. I think it's down to like, I haven't seen today's market, but 13 or 14 basis points. It's definitely narrowing. So we'll see what that has. But the market says it's going to go down. It's just when, I think, is the question. And it's not going to go back to zero unless we have a recession, I think.
Not too much to add. Our another global center out here to the audience. We have the chief strategist for Texas Fed on a kind of close discussion here for us about 30 minutes, and I think the sentiment is higher. Our trading desk is looking at it that way. Our advisors are looking at it that way.
But how long for how high, do you know? Or how high for how long?
I mean, I don't think we're going to see any relief in 2024. I mean, that's what we're anticipating. I think long-term borrowing rates are going to be about what they are today, plus or minus. I don't think there's going to be that much of an advantage to maybe short-term borrowing rates. So we're advising our clients here for 24 making much the same as 23, with no relief. And we don't see any evidence that suggests that there's going to be any kind of significant reduction. And to your point, a lot of these loans that borrowers that are in trouble, they set the whole business plan up on the event that they could refinance and could be cheap rates with massive bets. Right? And that's just a really bad business plan. And I think multifamily has always been more of a slow and steady investing, compounding over time. The moments in the markets you want to take advantage of long-term borrowing is utilized done. Which is the right way to do it. We see those sponsors well positioned in whatever they see is in good position because they're not subject to these. But I don't think, and I'd love to be able to say I was so wrong. I'll put it on LinkedIn and show that. But I just don't think that's going to happen. I think 24 is going to be okay.
Well, appreciate your guys' insight there. Obviously, the $1 million question. So moving on, something we touched on earlier. We've talked about the debt service constraints, but how are appraisals and potential loan proceeds being impacted in the current environment? I know Yonatan and Jay talked about expense inflation. I'm not sure if you guys have seen movement there on appraisals.
Well, again, I mean, cap rates just haven't moved relative to interest rates at the same pace. I mean, it's not even close. So we have not seen appraisal issues coming back. I mean, that's just not a talking point right now. We just assume the appraisal is going to come back at a decent value if we've underwritten it based on the cash flow that we can get. So now I would say, though, a lot of people have talked about refinance risk, and that's really true in the office and retail market. If you did a 5-year loan and you're repricing but now on today's interest rates, but you can't increase your rents. If you have a 10-year lease or whatever it is, retail office, they have a fixed income. And they might have to rebalance their loans. But in multifamily, it's going to be a little bit trickier because of the rent growth. I think that there's more opportunity, that there's going to be less re-leveraging. Plus, you can get longer-term fixed rates. So I just don't see maybe as much in the multifamily market as I worry about more the office, retail, some of those other ones with fixed long-term leases and what they have to do to reprice when their loans come up.
We're not running into too much appraisal risk for the same reasons. It's prudence and underwriting of the front end. It's imperative. When we take a client to market, their debt, you're requiring, without being able to require, that they get some kind of third-party market study, especially in construction projects. And so if your assumptions are defensible in today's environment, then we haven't really seen much of an issue. Because the only side we're starting to see a little bit of pressure or issue is just how are you going to pay insurance in Florida, how are you going to pay insurance in Texas. And those are two markets where there are discussions, but again, it takes a lot of work up front to try to figure that out. And other than that, you just get out and sitting in an issue. We're not trying to sell a 75 cap. Yeah, listen, so you're not, there's nobody's pressing you over that. You're underwriting real estate. got raised today. And so my team doesn't see crazy like this year.
Well, I've got one more question for the both of you. So if anyone has any questions or feel free to think over the next few minutes, then we'll open it up. But Yonatan, Jay talked about it a bit. We've all talked about it a bit. The over-leveraged variable rate borrowers. So, Metonic's playbook has always been fixed rate construction debt, 5 to 7 year loans for flexibility, relatively low leverage. What are you seeing as an outlook for some of these distress groups that we've talked about? We talked about loan modifications earlier. What type of distress do you guys see for those type of borrowers?
Well, we looked at our portfolio, in totality, and said, do we need to start having conversations with anyone about raising capital? What is it going to look like when their loan does mature? When does it mature? We're kind of looking at in the next 2 years, what's maturing in the next 2 years, because it's really hard to predict outside of that. And really having conversations early with people like, what does it look like? And what, you might have to raise additional capital. So we haven't seen a lot of distress in our current portfolio. I think we're just trying to predict what can happen in the next 2 years. If rates don't go down, if rates even go up further, what does it look like and how does it affect our clients? And let's start having those conversations now so there's no surprises. So that's how we're trying to see it. But I haven't seen a lot of defaults yet. That doesn't mean they're not out there, but we just haven't seen it yet.
Yeah, I think the national percentage is still pretty low with the multifamily defaults. That's a lot of the short-term borrowing, debt fund type money. Those loans are coming due in 2025. And so the question will become, what do the capital markets look like at that point in time? Because Jay made a comment earlier, it wasn't that it was bad, it was just bad capital structure. But with borrowers who just didn't have the balance sheet wherewithal to weather the storm if they missed one or two. The goal was to quit being a dentist and become an investor in real estate and buy a bunch of real estate. And that's what they did. Some of these groups moved to 1,800, 2,000, 3,000 units in the 6 months. And they barely qualified for 180 million days out of requirements, right? So there's plenty of money out there to right size these issues. And I think the first wave will come through larger loan sales. We're seeing it on the residential mortgage side. And you just took a $300 million portfolio of single family residential full mortgages in default. So I think that'll be the first wave. And so,
and was that regionally based, national and based? New York.
Now New York is 27,000 homes. And there's more in the works. But how that impacts commercial real estate side, it's not a direct correlation, but I think you're starting to see those loan portfolios start trading, which again, for the average investor, I think is being cognizant that this buying spree that everybody on the sidelines right now, the institutional capital today is going to happen. It'll be a handful of groups that'll trade some large portfolios, and the rest of it. Right now, we're seeing more of that debt fund stuff going to loan modifications that are distressing. So they're just kicking the can. And maybe it's all going down the road and hope for the sponsor to lease up a little bit more, get the rents up a little bit more. And, by then, maybe they can get to a debt cover to get those options for them.
Well, great. Thank you both for the insight there. And that's all I've got for questions. If you have any other thoughts, feel free to chime in. But at this point, I'll open it up, see if the group has any questions. Yes, sir.
I want to circle back to one of your topics you talked about on rent control and modification of how the loans go through on what you can charge for rent. It's a long-term investor, multifamily, inflation-adjusted assets, gold. Tell us how we should think about that risk and how it moves forward. Because if the legislation is going to lean towards capping what the cash flow can be or how it grows, at some point in time that turns into an appreciation challenge for the underlying asset. Tell us how you think about that in this marketplace, and then more importantly, what you think about what it looks like over the next 3 to 5 years.
Make sure I understand the question that you're asking it. So how are we thinking about the risk of potential federal legislation coming down and for cost? Is that okay? And then, so in the short term, again, what we're seeing is a trend towards the carrot versus the stick, right? Where there's an incentive to take your multifamily assets and to allow that borrower to restrict, say, 20% of the units to 60% of AMI units. And in exchange for doing that, I'll give you 35-year amortization, or I'll give you 7 years IO instead of 3 if it underwrites to 3 based on the exit test, or I'll give you 30 basis points in spread reduction. It's very similar to how, from a policy standpoint, Fannie and Freddie address the green and noise, right? Put in low flow toilets, LED light bulbs. 2-3 years ago, you get 25 to 50 basis point maintenance to that test. And then your tenants would go and change all the light bulbs and they'd flush the toilet 100 times. And it doesn't actually work, but you didn't care because you had to set your fixed rate with 30 dips, right? So in spread reduction. I think long term, that's probably a better question for those of us that aren't on the transactional side of the business. What we see is that 12-month thing. So what I think next year will look like is more of the same. I think the scorecard will pretty much be the same. They may tweak it, give a little more to agencies than less. There may be a little bit more incentive to control, not to control rents, but to incentivize you to take 20% is my example, and lock in a certain AMI. Over a 5-year period, I think you see what happens after the election, right? I mean, there's an election year. Agencies tend to always have some kind of modification or change, but I think there's a big risk there in just doing a carte blanche federal mandate to rent control. Because where's that? If you're 50% of the loan volume, right? Where's that loan volume going to go? Right? Because many of the reasons why we have also in an affordable housing problem is because the numbers don't pencil. There has to be some other kind of incentive to make it pencil. And so if you restrict rent in markets where now my coverage is I can't even go to my local bank where I have $10 million on deposits and finance because I can't public based on the numbers.
You're exactly getting at what I'm worried about. Right? So I guess my question is you guys being closer to the fire on the underwriting side, like you have an intuition of what directionality is.
We get directionality in 12-month increments, though. I mean, that's just how it works. So we're tip of the spear, but we get like the next 12 months. You don't see that policy down the road. It's a great question, and I'll make sure to follow up with the group because I'd like to have some of our folks that are talking directly to Fannie from a policy standpoint opine on what they think that looks like. But right now, it's an incentive program process to do. And the trade-off is I'm going to give you pricing, I'm going to give you leverage, I'm going to give you interest only to do it. And it's bite-sizing, right? It's not taking your whole asset. Fannie Mae's been the most aggressive with this. The other thing you have to consider is Freddie Mac just had a massive turnover in staff and senior executives. Right? So that will influence how they implement some of these strategies because they have a bunch of new people all across the country. So that's going to take time. So I wish I could say, here's what their plan is over 5 years. But what I think next year looks like is exactly what we incentivize you based on volume you do. It's a great question. Maybe I'll follow up with any information I think about it. Go ahead.
3 things I need to say.
Yeah, I'm writing down for you. Anything else? Yes, sir.
One question. You both got debt funds coming
For good borrowers like at 4%. That's the investment fund basically, right? I'm curious why would you charge just 3 or 4%?
Sorry.
Is there a kicker on it?
It's a 300 to 400 basis points spread over SOFR. Or some of them that have fixed rate product over the corresponding term.
So we're talking more 8, 9.
Yes.
Yeah.
Sorry if I wasn't.
Yep. Yeah, my hopes up.
To spread over SOFR. Let's refinance everything. I mean, the computer. You say application goes
We're going to pull all our loans out of the bank to all of us right now. Sorry, 300 to 400 over so.
Okay. Thanks for that clarification.